Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to discuss kind of a weird thing, but is probably really useful for a lot of you guys. So stick around to the end because we're going to go through a bunch of nuances. We're going to talk about how not to legally reduce your taxes. So this is inspired by an Instagram post that I saw, and I'll tell you a little bit more about that in a second. Before we get started, if you haven't already, please click the subscribe button, click the notification bell. It turns out as you go through, if you like the video, please click the like button. If you would like some assistance from us, please click the link below, clarity.fm/Michael Rosmer to book a call with me, and let's dive into this. Okay, so this is one of a series of videos that I'm doing based on this Instagram post that I saw, which basically gave some bad information. And so I find bad information to be annoying. And as a result, could not help myself but to go and create a video discussing it. So I'm going to give you kind of the scenario of what it was that it was talking about. Basically, it had a picture of Jeff Bezos, and then it said something about like how big companies avoid tax. And they said, oh, company X goes and they take their IP and they put it in the Cayman Islands. Okay, they set up another company, company Y, in the Cayman Islands. Then company X goes and makes $50 billion, and they don't want to pay tax on the $50 billion, so what do? Well, they go to, they license the IP from company Y, so now they pay company Y $50 billion, which reduces their taxable income, and they don't pay tax on that. Cayman Islands has no tax, therefore they don't pay tax there, and voila, the company paid no tax. Now, on the surface, this may sound perfectly reasonable, and I can tell you when I was getting into, before I had an expertise in international tax planning, when I was just doing normal entrepreneurship stuff, my own businesses, etc. One of my companies, we would buy health equipment from China and we would ship it to Canada, the US, and we would distribute it there. And we were thinking about, hey, look, is there some ways that we should be structuring? And so, you know, I would have ideas like that, right? I would think things like, hey, well, why can't I just set up a management or a marketing company in British Virgin Islands where there's no tax and just charge whatever the profits are to that company? Like, what can the government do? It turns out they can do a bunch of stuff. And similar sort of ideas, right? Which is kind of the basic premise of here. And so, you know, a person could say, well, you know, part of the reason for using IP is that IP is very hard to quantify the value of, etc. And so there's all these comments where some people would say, oh, you know, this is like a simplification of what they do. Well, it's like, it's not really what they do. And if you were to take that approach, you would probably get in a lot of trouble. So that's not how to avoid tax. Let's talk a little bit about some of the reasons why this doesn't work, why it didn't work historically, why it certainly doesn't work now in a lot of the world, and some of the other common things that might go along the same way that you might think that you can avoid tax, but in practice you cannot, okay? So this post, obviously, because of the fact that there was a picture of Jeff Bezos, it was very Amazon-centric, right? You're thinking people were talking about, Amazon, they're ripping things off. Jeff Bezos, he's, you know, a horrible guy, whatever. I actually happen to like Jeff Bezos and I happen to like Amazon. I think it's a fucking great company. I think they do an amazing job for the customer. I like Jeff Bezos' attitude of investing in the company and helping to make things better for the customers. Frankly, a lot of people's lives are way better because they can order off Amazon. So that being said, let's look at kind of the natures here. So from the US law, they could actually set up a company in this example, Cayman Islands, okay? Would they want to set up the company in Cayman Islands versus somewhere else? That's a whole other conversation. Typically, probably not. You would notice that almost no companies would do that. They would do it in Puerto Rico. They would do it in Ireland. Apple is now in Jersey. You know, there's a few of these, but Cayman Islands is very common for the hedge fund industry. Bermuda is common for the insurance industry, and there's some reasons for this, right? I'll maybe do some videos in the future about why that would be. But they could actually set that up. Now, I'm gonna separate out here for a second the US versus most of the other countries that you might be from, right? So whether you're from France, Germany, Scandinavia somewhere, Spain, Portugal, Italy, Canada, Australia, New Zealand, Japan, you know, like run down the list. The majority of places, you're already off to a bad start. Why are you off to a bad start? Well, aside from, you know, the modern situation with banking and all the challenges that that's likely to create for you, the bigger deal is the fact that you need to have management and control. So in other words, we talked before, you can check out some of my videos on residency and corporate residency about how where a company is resident is not the same as where it's registered, And so you don't just get a 0% tax rate because you registered a company at 0% tax country. You have to have tax residency there, which is typically based on the management and control. And so if it was actually managed from, say, Canada, from Australia, from Germany, from Denmark, from all these places, it would be just like a local company and taxed fully on the worldwide income, just like a local company. So in the case of the US, they don't use management control rules. So fair enough, fair game. All right, let's move on. All right, so now we say, well, they transferred their IP there. Okay, well, the question is, how does the IP get there, right? This is actually a pretty important question. You can't just place your IP there, right? And so we can look at a variety of different things that might happen, right? Can you turn around and say, hey, listen, we're going to do something like that? Yeah, you might be able to, right? Usually it's not just a question of the IP, it might be more likely about the distribution rights. Okay, that's another thing that kind of goes in there. So you can say, well, they're kind of the same, Michael, you're splitting, splitting hairs, whatever. Okay, fair enough, but the bottom line is you'd have to transfer it there. Now, in order to transfer it there, you would have to make some sort of an investment. Now, if the IP was actually developed, let's say in the US, in the parent company, then the foreign company would have to pay something for that. Now, notice that that money that's being paid is either reducing the expenses, therefore basically increasing the taxable income of the US company, or being received as income, which is also reducing or increasing the taxable income of the US company. So that transfer is taxable. Now, Google did that quite famously back a while ago. They paid, I think it was like $2.5 billion or something to transfer their IP abroad. Some of it, we'd have to get into the technicalities of what Google's done, right? But loosely speaking, the point is you could, in theory, transfer things. Microsoft had an agreement where they would transfer distribution rights. Basically, what they did was they turned around and they transferred distribution rights from the US company to a Puerto Rican company, and then turned around and sold distribution rights back to a company within the US at like a dramatically higher price. And there's a whole argument about how exactly that happened and things like this. But anyway, the bottom line is, okay, you can have that, but there is a tax consequences. So it's not just like, oh, you're magically paying 0% tax. Okay. Now, let's look at the next part of that, which is when you do a transfer between these two related parties. So you have two companies that have the same ownership that are in different countries cross-border. This is what's called transfer pricing. I have a video on transfer pricing. You can go check it out. You can't just pay whatever you want for that, okay? So not only can't I sell it for whatever I want, but I also can't license it back for whatever I want, okay? It has to be a fair market rate. The idea being that, hey, listen, the fair market rate should more or less eliminate a lot of the advantages that you would artificially create, okay? So somebody actually good in the comments in this mentioned, hey, this is base erosion, profit shifting. Yeah, it's kind of that type of thing. And, so great. How does this get handled? Well, basically, there has to be a transfer pricing study. The transfer pricing study is going to determine what the fair market rate is. And so you would not be able to just be like, oh, hey, $50 billion, here it goes, That being said, you could certainly transfer some value abroad, okay? Now, how this might happen, for instance, in the case of Apple, is Apple has what's called a cost-sharing agreement with company. So what they used to have was Apple US, and then they had Apple Operations International, Apple Sales International in Ireland, which were Irish registered but not Irish resident companies. Very important distinction, right? And basically what would happen is the foreign company would pay 60% of the R&D costs to the US parent, and for that they would get the distribution rights outside of the Americas. So all of the sales for Apple that took place outside of the Americas, the revenue would go into the Irish registered company, okay? And then the stuff for the Americas would go into the American one. The American one would pay taxes on it. It was a fairly high amount of tax over time, whereas the one abroad did not, okay? That was what was happening there. Now notice there's some really important differences here, okay? Between what's described, because this might sound very similar, right? You say, oh, well, it's the same thing, it's a simplification. Well, kind of, but details really, really matter, okay? So if you screw it up, it could be the difference between a big tax bill or going to court or tax fraud or something versus, sleeping well at night and having a great situation. In the case of Apple, their cost-sharing agreement went through what's called an advanced pricing agreement. Advanced pricing agreement means that the IRS basically looks at the transaction and agrees to these terms in advance, so they know. They're like, hey, look, you guys said this is the case, and it's agreed upon, so they don't have that uncertainty, which is a pretty reasonable thing to do, right? All right, but notice here how we have a difference. In one case, you generate the profit in the US and then you try and drain it out. In the other, the profit is never generated in the US, okay? And I want to point out a really important distinction here, which is that a bunch of people would go and say, oh, you know, you're ripping off America. It's like, well, hang on a minute. The sales that Apple is making through their international subsidiary are not American sales, right? So they're not even North American sales. They're not even the Americas sales. They're Asia, Europe, Africa, Australia sales, right? So if that's the case, are you really ripping off the US? I mean, yeah, there's less US tax paid in the short run, but who should maybe really be upset are the Germans or the Danish or the Dutch or, you know, somebody else. Because does the US really deserve the tax for all of the sales in the world? That's an interesting question, right? Interesting question to ask. And that's like one of the things that kind of is a little bit infuriating to me when I hear these discussions, is that people make a lot of judgments without considering the global perspective. You know, I remember seeing it was like Amazon had paid no tax one year in UK. Now, part of the reason was they had no the headlines that the newspapers were saying were like, Amazon does $800 million of sales in UK and pays no tax. It's like, yeah, but they had no profit, you know? So they took all the money that they made and they reinvested it into giving more value back to the customers, driving costs down, giving a faster customer experience, et cetera, which is basically a benefit back to the people in the country, which is kind of similar to what you would do if you were to put money in for taxes, right? And so you don't pay tax on profits, on revenues, you pay tax on profits. So this was an unreasonable thing. But more importantly, you know, I think it was the Americans were getting furious about this, and I'm like, why would the Americans be furious about it? The UK people should be furious about this. They're the ones who should be mad. So that's, to me, something that's a little bit like, a lot of the thing that happens when you start looking at international tax planning is there are like legitimate tax justice questions, but the tax justice questions shouldn't center just on your particular country. They should center on all the countries that are involved, okay? So anyway, that's the next thing. Now, in reality, let's look at how it would have worked that would have caused problems if they had done it the way that it was told in this little slide, right? So there they say, oh, hey, well, no big deal. What we're going to do is we're going to turn around, we're going to license, we're going to have royalty payments to here, right? Well, here's the problem. Royalty payments are subject to withholding tax. And withholding tax paid out to Cayman Islands. Cayman Islands doesn't have a tax treaty with the US. Basically, the general rule of thumb is no country with zero tax has tax treaties, with the exception basically of UAE. Sometimes, like some of these other ones that they have, like, you know, Qatar, you know, maybe you could end up with zero tax in certain scenarios, things like this. But basically, if you have zero tax, if you're BVI, if you're Anguilla, if you're Cayman Islands, if you're Bahamas, etc., then you will not have tax treaties, double tax treaties we're talking about, with other countries. You may have tax information exchange agreements, but you will not have double tax treaties. And the double tax treaties are what reduce the withholding tax rate, okay? So the withholding tax rate actually is quite high. If I recall correctly, right now it's 30% on royalties coming into the US, meaning that if you are paying a royalty payment to a foreign entity, that's subject to 30% withholding tax. Well, 30% withholding tax is higher than the corporate tax rate of 21% at the federal level. So barring the fact that you would have state taxes and things like this, you actually lose out by doing this. It is actually a worse scenario for you, okay? So these are things that if you don't understand the details, it can really screw you up, okay? So now let's kind of finalize it off, right? So on top of that, what they fail to say is they're like, okay, well, now the money is kept out there, okay? Now, oh, by the way, going back to like a lot of countries, I mean, a lot of countries have royalty withholding tax. In fact, even Hong Kong, which has a famously territorial tax, has special rules around royalties, okay? So royalties are often a really bad way, like licensing fees, etc., to get money out of countries across borders. It's not a very good way to go if you can avoid it. Very, very often when we're talking to clients, we're like, hey, you know, is this like services income? Because that'll be way easier to deal with than this if this is royalty income. All right. Now, let's take a look. Let's dive in. Let's dive in a little bit deeper. Okay. So let's assume that they actually do this. The money is now out there, right? In this case, they've got $50 billion now. In reality, like we said, royalty withholding taxes would have been payable, so that hurts as well. But let's assume that the money's there. Well, now what? Now you've got this money in this Cayman Islands company, and the Cayman Islands company is not in a position that it's going to spend the money on much, right? There's no operations there, is basically the assumption of this article. It's just a shelf company or whatever sitting there, shell company. And so now, what's the deal? Well, now you're going to be in one of two scenarios. Now, it used to be that there was a good chance that they would force you under CFC rules to bring it back. And prior to 2017, if you brought it back to the US, you were subject to full corporate tax on it, okay? So you were gonna pay, now at the time, the tax rate was like, just under 40%, right? So you pay almost 40% bringing it back. This was a horrible move. This is a terrible tax planning strategy. Like, you paid way more tax to the US. So ironically, if you had done what they described, far from being unpatriotic, if they want to call paying tax patriotic, and that's a whole other conversation, this actually would have been more patriotic, okay? So what companies would normally do was they would keep the money abroad for like decades, right? They would just say, we're just going to accumulate it there. Maybe we're going to borrow money domestically in order to fund our operations. Then we'll have write-offs on the loans, etc. We'll maybe reinvest that money. It depends a lot on the CFC rules in the particular country that you're dealing with and things like this. Now, after 2017, in the US, they introduced something called GILTI, the Global Intangible Low Tax Income, which has very little to do with intangible or low tax income. But basically, this made it pretty difficult, very much impossible, not impossible, but close to impossible to keep that money offshore anymore. And so now they're basically forced to bring it back, and often then they end up with GILTI tax on top of it. Okay, so although if structured properly and if all the different things came together correctly, etc., it is possible that they could have set it up so that they could have reduced their taxes a reasonable amount and maybe ended up paying 10.5% at the end. That's possible. The whole long GILTI is pretty complicated, so we'd have to kind of go through that. But in most scenarios, this is not really an amazing situation. Now, if it wasn't the US, if we were talking about some other country, then they typically have participation exemptions. So sometimes they can bring the money back, all right? Now, this depends. So for example, in Canada, the participation exemption holding type company rules fall under something called the exempt surplus rules. Now, the exempt surplus rules would allow Cayman Islands to be used. But and so you could repatriate it as a dividend, but only if it's payable out of the active business income. And so if you're earning royalties income, once again, the question is that active business income? And typically, royalties income would be considered passive, royalties, dividends, interest, etc. So, and then there would be a risk also, depending on lots of different factors, that would be considered what's called FAPI, foreign accrual property income, and hence they would force you to bring it back as well. So it depends case by case, but the bottom line is the simple idea that you can transfer this money out and just bill what you want across borders and things like this is not true. Okay, there's very few countries in the world that don't have transfer pricing rules. That's your first problem. Then often increasingly you need some sort of foreign substance. They do actually care about how the income was generated, things like this. Like, they're not stupid, okay? The tax departments are very smart. They've been spending decades having people try and get around their rules, and gradually, progressively over time, they've come up with better and better rules to kind of close up a lot of these loopholes, okay? So now, in that situation, could a company like Amazon reduce their US tax? Of course they could, and certainly they do, right? There's a bunch of different things that they do to do that. Just like most of these multinational, pretty much every Fortune 500 company has an international structure and is using it to reduce their taxes as much as possible. And I think that's perfectly legitimately, because why wouldn't you, right? Especially when you're doing business internationally. A lot of the sales aren't sourced domestically. It doesn't really make sense that you would have all this foreign business and you would pay domestic tax on it if you didn't have to. So anyway, I hope that's helpful. If you want to find out how something like this might apply to you in your situation, you can reach out to me. You can book a call, clarity.fm/Michael Rosmer. There is a link below. You can also check out our websites, offshorecitizen.net, offshorecapitalist.com. Click the subscribe button, click the notification bell to check out lots of our other videos. If you like the video, click the like button, share it with your friends. Lots of different things. Check back here for international structuring, for tax planning, asset protection, company formations, banking, payment processing, residencies, citizenships, all that kind of stuff. So anyway, hope that helped, and we will see you guys on the next video.